Hi everyone, this is Jay Pace from Providence Property Group. Today I've got a special video for you. We've been working quite a lot on providing more and more data for clients to give them a better understanding and perspective of currently what's happening in the property market. There's lots of questions that we've been fielding now for the past few weeks, and we've been flat out, so I didn't have time to put together a property market update, but I think this is actually going to be better. What you're looking at right now is my screen, and I'm showing you the Providence website. We've created a chart for you that I think is going to give you some really good understanding and insight into the property market. So what I'd like you to do is go to the resources page on the Providence Property website. And once you click on that, you can scroll down past the tax freedom day calculator, and you can actually go to the 55 years of boom, bust and recovery. And you'll see that we've got a chart here that's actually got 55 years of Australian property pricing. Now, this is national pricing. And as you can see, there's some data in there, and I'm going to let you take your time to review this in your own time. But today I just wanted to give you some commentary and take you through this chart from 1971 to where we are today. My recommendation, because there's a lot of data in this video, is that you open a second tab, you keep me talking in the background, and maybe you follow along with what I'm looking at and you click on the tabs yourself in the actual chart. Totally up to you, but I've just got to focus on the data here. So I'll be moving the chart around a little bit, but I'm just saying I think it might be good as well if you just open a second tab, have this chart going and have me talking in the background, okay? So I'm just going to make my head a little bit smaller. So we've got some room here. We can scroll down. So just quickly, bar chart, line chart, so you can change up here to get a bit of understanding. You can also track the median dwelling value over the last 55 years as well. You can also put in when the data started coming out, vacancy rate data, listing index data, and also sales volume. So you can add quite a bit of information in there. And the other thing, and the last thing we'll probably end up talking about, will be you can actually also track all the downturns that we've had over the last 55 years, how long they lasted and what happened, and a bit of a synopsis on those downturns as well. You can turn on and off the global events and also the national events, which affected the market during that time. So it's quite an interactive chart. And as I said, for me, the biggest thing that I see is that the media cycle is so short, but also are our attention spans and our memories. So it's always really important to go through long-term data sets to give us a really good understanding as to where the property market's most likely going to be as it goes forward. So if you need to pause the video, get the chart ready, go for it. If not, I'm just going to start going now. So this is every year of the Australian property market since 1971, so 55 years. And this is adjusted also for inflation. So what you're looking at is the real return, not just the sticker price that's obviously going up. And if you notice the shape here, you'll see that the green bars are above the line, consistently taller than the red bars below it. So this is me getting into my stockbroking head a little bit from back in the day, but basically you're seeing higher highs, and then sometimes you're seeing some lower lows here. You're seeing some V-shaped corrections. It's really important to just get an understanding of this market in that respect. So what I can see here is that the booms have been bigger than the busts, and that's something that's been happening over and over again consistently. And I guess this asymmetry that we can see here is the whole story kind of this chart. All right, so let me start to take you through because I could spend hours on this chart. I mean, I did to create it, but for this video, we're going to actually look at different maybe errors in time for this specific chart. Okay, so let's focus on the 70s. And what you can do is you can put your mouse on the chart, you can click on it, and then if you can scroll back and forward, as you can see I'm doing here, but you can also zoom in. So if you zoom in, you'll be able to get a little bit closer. And then if you stuff up the zoom like I just have, you just press the reset zoom button in the top there, and that automatically brings you back to where you kind of need to be. So it does put you in a, it is pretty intuitive and quite easy to use. So as I said, let's talk about the 70s. So they look ugly in real terms, actually. If you look at, this from 74 to 78, it's really not attractive. But it's an inflation story, and prices were rising in dollar terms. And most of these years, we saw that happen. But inflation was actually running at 10 or 11%, and it was wiping out the real gains that you were actually getting from property prices. So even though property prices were going up, inflation was actually beating those movements. and it was affecting them quite significantly. So in 1971, and if you go over any of these bars and you actually click on the bar, it will give you a quick synopsis and it gives you a little bit of information. So it first of all tells you the year. It will tell you what the property market nationally ended up being, again, after inflation's been taken into account, so the real return. It will tell you the median dwelling value. So in 1971, the median dwelling value was $28,000. And it also tells you the peak RBA rate for that time of year. And then it gives you a quick little synopsis there as to what happened nationally and also globally. So again, I'm sure some of you guys can nerd out on this and take as much time as you want. So if we have a look here, you had the Nixon shock and the end of Bretton Woods, and look these up if they're not making sense to you. That was in 1973. You had the pre-OPEC boom, and then the oil embargo in 1979. So you had the Iranian Revolution, oil prices doubling again, and back then banks actually rationed credit. A branch manager decided if you got a loan, and that was about to change. And when it did, everything kind of changed with it. So this is really important, because if you go arguably through the best time to be alive, in my opinion, which was the 80s. So now let's scroll a little bit more here. Okay. 1982 is the worst year in the entire 55-year data set. Okay. I'm just going to quickly turn off the median dwelling value and get rid of that there. Okay, great. I'm going to scroll in again. So the 1980s. So again, 1982, I've just clicked on it there, down 10.3%. So the RBA actually pushed the cash rate to 21%, and that was to kill inflation. This was the deepest recession since the 1930s, okay? And I want you to hold on to that number, a 21% cash rate, which resulted in a 10.3% real loss in value of property prices. Now, why do I want you to hold on to that number? Because nearly every single day, I see a newspaper or some type of media article talking about a crash in the market. And then when I look at the actual numbers, they're talking about, usually it's below 1% drop. So 0.7% drop, 0.6% drop, 0.2% drop. I've even seen people say this is the beginning of the crash. This is a real number, okay? So that's your actual benchmark for what an actual severe downturn looks like. And how many times have you seen the news, especially over the last 5 years with all the stuff that happened with the pandemic, them increasing interest rates 13 times in 2022? How many times did you see them say, this is the crash to crash out all crashes, like the biggest one we're going to see? So everything since this downturn back in 1982 is what I actually measure everything up against in regards to real value dropping, okay? Then we've got 1983 to 1991. So just showing you that kind of change there as well. So now I'm just moving the chart along. This was deregulation, the biggest boom on record, which you can see there in 1988, and then the hangover. So 1983 is the hinge point of this kind of entire chart. Hawke's government floated the Australian dollar and deregulated the financial system during this time. And foreign banks get licensed, and credit stopped being rationed and they actually start being priced so you can buy it, okay? And every boom this size creates its own hangover, and rates go from restoring confidence to slamming the brakes on. So I'll quickly focus on this for a moment because it's very reminiscent of where we are today. So you can see here in 1985, the Hawke government quarantined negative gearing. So this is the first time Australia actually was stupid enough to get rid of negative gearing, 1985. And what ended up happening is we saw rental supply fall sharply, which is what we've already got now with vacancy rates at record lows. And then what we saw is we saw rents spike. And when people are scared of buying into a market or they're procrastinating, those that graduated from being renters to owner-occupiers stay renting. And if we keep bringing the amount of people into the country that we have been, which is currently one person every 75 seconds, all that's going to do is put excess pressure on the current rental supply. So what's going to happen? Landlords like you and I are able to increase our rents because we've got 50 people showing up to a open lease inspection instead of getting 10 people show up. Now, what happened after this? What we got is we got the first full year of negative gearing being taken away. All right, that was 1986, the year I was born, and the dollar actually also fell 40% during that time. So that was a really bad year, but the Australian property market still only dropped by about 5.8%. And again, they didn't have the issues that we have today, which I think will actually speed up the recovery of the downturn that we're currently in, where you've got record vacancy rates today, you've got massive labor costs. We don't build anything in this country anymore. We bring everything in, which means we're very exposed to import taxes and import costs. You've got a huge amount of migration. We didn't have that before. So again, this was going on in the 1980s without all the issues that we're seeing today. What ended up happening is in 1987, you can see there on the chart, negative gearing actually got fully restored in September. So it was less than 2 years that negative gearing was taken off the table here in Australia. And in 1987, it got restored. Investors flooded the market. This would have been a negative year again, most likely, without negative gearing being restored. But once it got restored in September, money flew back into the market, which ended up having a negative year become positive by December. Okay, that's basically what ended up happening. This was also not a great year, though, for the Australian stockbroking stocks industry. And on the 19th of October, we had Black Monday, and ASX actually fell 25% in a single day. And capital started to flee out of equities and obviously started to go back into property. But again, that was only in October. And that was after negative gearing was restored in September. So it's actually quite a quick move. So just now getting out of that, what we saw the now full year of negative gearing being restored. Okay, that is 1988. Again, like I just said, this is the largest boom on record, 23.5%. I am not saying that this is going to happen again. Okay, what I am saying though is this is rhyming to me quite a lot. This seems really similar to what it is. The interesting thing too, the timing. I mean, negative gearing getting taken away in 1985, it gets taken away in 2027, but it gets proposed in 2026. Then you've got 1 full year of negative gearing away, which is going to be from the financial year of 2027 onwards. Then it gets restored in 1987, which is going to very closely coincide with the federal election that we're going to see in 2028. And again, it's not going to be a surprise that the oppositional parties are going to be trying to run on a similar platform, which is going to be end toxic taxes, etc. And then it gets fully restored and we have the biggest boom in Australian history. I'm not saying that's going to happen, but we're saying from a biopsychology perspective, this all makes a lot of sense to me. So every boom, like I said, this size creates its own hangover. And 1989 to 1991 is exactly what happens. So mortgage rates are at 17 to 18%, and the market is cooling sharply into the recession that we had to have. Everyone remembers Paul Keating's recession we had to have. So in the space of about a decade, this chart shows you the single biggest boom and one of the deepest corrections back to back. Okay? That's not an anomaly. That's what deregulation of a credit system looks like the first time it actually happens. Okay, now let's look at 1992, which is here, to 2003. So I'll just move this a little bit more. So there we go. So you can see that. This is recovery, the Asian crisis that barely kind of touched us as a country, and CGT-fueled boom. Okay, now the 90s are a slow rebuild. Recession bottoms in 1992, Keating stabilizes things, and by 1997, the Asian financial crisis is tearing through Thailand, Indonesia, and Korea. Australia barely feels it because the floating dollar and relationships that we have with China actually insulate us. Now, that's an early example of something that you'll see again, all right? Global, shocks that everyone assumes will hit us hard, and they don't, all right? Now, let's keep going. If we look at the acceleration from kind of 2001, I'll move the chart again, which is here. So we've got 2001, 12% increase. So from 2001 onwards. Now, we're looking at 1999 to kind of 2003, okay, here on this chart. You can kind of see that. And what we're seeing here is an underrated year, in my opinion, 1999 on this chart. And that's when the 50% CGT discount was actually introduced for assets held over 12 months. And I'd argue it's the single most important policy driver of the boom that followed that announcement, okay? And combine this with September 11, lest we forget, driving global rates down, and you get a credit boom. Housing credit growing 20% in just a single year, and then you're also getting national prices up roughly 40% over 2001 to 2003. That's a huge increase in a very short period of time. And you can just kind of see these steps going up over there, okay? Next, we got 2004. I'll just move this again. 2004 to 2013, okay? And that's the pre-GFC peak, the GFC itself, and then the fastest rebound in kind of the data set, okay? So 2006 is actually a personal mark on this chart. Where are you? Here we are. Because Providence Property Group was established in 2006, and we thought this is going to be fantastic. Like all people, you know, we're going to take this thing to the moon. And then 2008 happened less than 2 years later. And the GFC happened, and we were having lunch and thinking, you know, is this the end? What's going to happen? I mean, again, we had the data and we understood what happened, but the GFC was a big, scary time. I was actually stockbroking at the time. I wasn't even in the property market. And I remember people were watching Sky News and Bloomberg, and I was watching people, you know, in the US, New York Stock Exchange, walking out of their offices with boxes, people getting fired, and people weren't being let back in offices. It was a crazy, scary time. And I'm sure you remember that. So if we kind of look at this, we founded Providence in the middle of the resources boom, and Perth led the country during that time. And I remember listening to stories from Linton and Simon, the two guys that started Providence back in 2006, when I joined them in 2014, just telling me about how Perth had performed so well during that resources boom. And then it reminded them as we got into 2020, how resources were required as well as quantitative easing was pushed out globally to kind of recover from COVID. And I remember both of them were saying Perth's going to boom again. And I thought, no, again, I was a bit too young to remember some of that stuff. But again, they were right. And our clients made a lot of money during that Perth boom. So experience is important, everyone, experience. So then the GFC actually hits, and that is 2008. Okay, so if you click on that, you'll see that there. Lehman Brothers collapses in September 2008, global credit markets freeze, and here's the number that actually matters. Australian property fell 7.4% in real terms. Now, if you compare that to the US, that was down about 17%. Or the UK, for example, that was down about 11%. So we had the mildest correction of any major English-speaking market. And it's interesting here, and again, just putting my stockbroking hat on, this little V kind of shaped recovery. So up, down, back up again, okay? So again, that's just really interesting when you kind of look at those patterns in the market. So now the RBA cut from 7.25 to 3%, okay? And that's the fastest easing actually on record at the time. And the Rudd government stimulus, including the first homeowner boost. And I remember I had friends and family that bought during that time in 2000, just after the GFC, 2008, 2009. They were receiving a $40,000 grant, 40K, and zero stamp duty. What a time to be alive, just giving away money. So by December 2009, prices had actually fully recovered. And from trough to full recovery, about a year. And that's the fastest rebound anywhere on this chart, okay? Fastest rebound that we've kind of ever seen. Bam, bam, back down and up, okay? Now we've got 2010 to about 2013. So again, you can still see that in the chart where I've got now. Post-stimulus, rates go back up to around 4.75%. European debt crisis weighs on sentiment. So that's when Portugal, Ireland, Greece, and Spain, or the pigs, looked like they were going to have to leave the European Union because they were all going bankrupt. Queensland floods actually hit really hard at that time. And you get the longest kind of downturn in the modern data set, and that's 20 months, okay? During that time, okay, 20 months, okay, of that kind of downturn. And still the market turns in 2013. And once the RBA starts actually, you know, easing again, we start to see that recovery. Now the RBA cut from 7.25, as I said, to 3% during that time. So that is still the fastest easing that we've seen. So 2014 to, which is when I kind of joined Providence, to 2020, the regulator era. Okay, this is when APRA learns to actually apply the brakes without breaking the whole market, and this stretch is really a story about regulation. Welcome to Australia, not economics. And APRA starts actively managing investor credit growth, and it's capping it at about 10%. Okay. And in 2014, this happened. And I think it's really important because they then started restricting interest only loans, and everyone thought the party was over. Okay. This was actually a big year for Providence because we started pushing more towards established existing properties over anything else. It made much more sense. The new builds do make sense at certain times, but at this time they didn't. And we started focusing on established, and I'm so glad that we did. So what we're seeing here is then we got 2017 to 2019. And this is, like I said, the most severe kind of pre-COVID downturn on the chart. And like I said, this is the Banking Royal Commission, all right? And that got announced, and lenders started tightening standards overnight. APRA said you can't do interest-only loans anymore. They capped it at 30% of the total amount of loans each bank was able to do. I remember, I think it was ANZ that was at like 60+%, and they had to bring it down to 30. So everyone thought, well, if I have to do interest plus principal, even with negative gearing, I can't actually cash flow it. And if you Google the headlines during that time, it was the market's definitely going to crash. We're going to see the biggest crash ever, one for the ages. Okay, now Sydney prices actually fell specifically during this time at about 15%. Melbourne was around 11%, I think it was. Yeah, 11%. But nationally, about a 10.1% drop in property prices. And how does it end? I mean, that's the question, because we're in the middle of that right now, and everyone's like, oh, it's over, right? How does it end? Well, the 2019 federal election happened, and again, we're only a couple of years away from the 2028 election. Labor had proposed changing negative gearing on established properties. Okay, the coalition actually won in a surprise result, and the market recovers within weeks. And before a single fundamental had changed, that tells you how much of any correction is confidence and policy uncertainty. Okay? Not just interest rates. Really important to understand that. All right? Because we live in an era where we're just surrounded by opinion that's disguising itself as fact. All right, let's keep going now. We're near the end of the chart. 2020 to 2025. Okay? COVID, the biggest boom since 1988. Happened, okay, during this time. The fastest tightening cycle in history also happened, all right. COVID hits 2020. Borders close. I wasn't able to get haircut. People weren't able to go to work, but everyone apparently was still able to go to Bunnings. RBA cuts to 0.1%. That's the lowest interest rate ever, okay? The lowest cash rate ever. 291 billion in fiscal support. Now, I want you to understand this. When an economy looks like it's having trouble, the main playbook is typically quantitative easing. You would have heard of quantitative easing during the GFC, 2008. We printed more money during the quantitative easing process of COVID. We printed 3 times more the amount of cash during COVID than we did to save the economy during the 2008 GFC. So just let that set in as to how much money they printed. And then people were kind of scratching their heads when inflation was going up, going, oh, why is the dollar dropping in value? And why is inflation going up? Because we just printed so much damn money, okay? Now, property actually dipped 2.3% over 4 months, okay? Then, by around September, she surged again, okay? I remember because I sold an investment property in March 2020, and I bought and upgraded my owner-occupier property in September 2020, and everyone was telling me the market was done, I'm an idiot, I shouldn't be doing that. So 2020 still ends up, as I said, 2.7% in the positive for that year. It's one of the fastest V-shaped recoveries on record. And it happens inside of a global pandemic. Again, we were told this is just terrible. So you had here, 2021, you had the drop down starting of that V, and then you had the rebound here in 2023. Okay. Now, 2021, let's focus on that. 2021, we were up 19.5%. Okay. This is the single largest one-year increase in the entire 55-year data set. It's bigger than 1988. And the emergency rates, the stimulus, and a pandemic-driven demand for space all kind of compound at once. So it was just the perfect storm. And then the reversal of 2022, the RBA starts to rise rates. They said they weren't going to touch them until 2023. I'm sure everyone remembers that. And we had 13 consecutive rate rises from 0.1% to 4.35%. That's the fastest tightening cycle in Australia's history. Okay. And what happened was real price falls were about 10.1%. That's the second largest calendar year fall on record. That's right behind 1982. All right. But here's kind of the number that matters more than the fall itself. Even after that historical crash in prices, values in December 2022 were still 11.7% above where they were before the pandemic even started. So it didn't erase all the profits. The correction erased the froth, but not the underlying gain. And by late 2024, most capitals had already set new records, which brings us to now, the 3 RBA hikes that we've gotten in the first half of 2026, plus the federal budget, negative gearing being taken away, and CGT changes. That's this cycle. That's where we currently are at, okay? Now, that brings us to now. 3 RBA rate hikes in the first half of 2026, plus the federal budget, negative gearing changes. As I said, that's the cycle version of a trigger. And every era on this chart has had one. So oil shocks, deregulation, APRA, the GFC, COVID, and now tax reform. Tax reform is the new shock, okay? But here's the number that kind of matters more than the fall itself. Even after that historic crash, okay, we've seen prices go over and above, okay? And by late 2024, like I said, most capital cities had already hit new records. And this is an important thing that I want you to look at right now. If you're on the chart, I want you to go to the downturns button. So it's just in the top kind of right-hand corner next to events and global. It's just before that. Now, if you click this and hit the reset button too after you've done that, reset zoom in the bottom left-hand corner. So you can zoom out again if you haven't yet. So your chart should look like what mine's looking like now. In 8 out of the last 10 downturns, the calendar year that the market bottomed still ended flat or positive. And in every single one, prices went on to reach all new time highs within 1 to 4 years of that trough. So the average time to recovery across 55 years is about 2 years. And the trigger is always different. The recovery shape is never different. It's always the same. So I want to thank you so much for listening to my voice for nearly half an hour. I really hope you use this chart just to give you some insight. Click on each one of these, have a little bit of a review of it. I made this chart, so if you're not happy with it, all complaints can come back to me. If there's something that you think isn't on there that should be on there, please let me know. But all we can try to offer you is education and understanding about how the markets work. And once you have this insight, once you've been through the battles that we've been through with property over such a long period of time, it makes it so much easier to traverse this type of terrain. So if we can help you in any way, please let us know. We think there's going to be a huge amount of opportunities while everyone's scared. And we've just been so flat out for the past few weeks now, especially with self-managed super fund purchasing with the deadline of the 10th of August coming up. But after that, if you need some assistance, please contact us. We're absolutely happy to assist. Have a great day.